Which of these is least likely a secondary source of liquidity? So we've got least likely here, and we're looking at things that two of these will be secondary sources of liquidity and one will not be. So we've got filing for bankruptcy, secondary equity offering, or C, renegotiating debt contracts. So a secondary source of liquidity is essentially a way to get liquidity, but it's not going to be our first way to get it. So the first way to get it is going to be to access our credit lines or just take cash off the balance sheet, something like that, something we can do really quick. A secondary source is going to be something where we are doing something like raising capital. And so looking at these three, putting something more in the bucket of raising capital, that's going to be answer B, secondary equity offering to get more liquidity. Filing for bankruptcy and renegotiating debt contracts are going to be further down on the totem pole than secondary equity offering, because these are going to be a lot more unfavorably seen for the company. So they're going to be seen as more of a last resort thing to save the company, not a secondary source of liquidity. Answer B. Which of the following is most likely a primary source of liquidity for a firm? So primary source means this is where we can get liquidity the quickest. So we're going to be looking at these from the standpoint of where we'd be able to access money fastest. So we've got A, line of credit. We could typically access this very quickly since line of credit is already a debt that is open for us, and we'll have some limit or amount that we can grab money from for that. So that sounds like a good answer so far. B, liquidating assets. Line of credit is going to be quicker than that. Liquidating assets is going to require finding a buyer for those assets. C, negotiating debt contracts. This is also going to be slower than lines of credit and take more time. Line of credit is already open, so we should be able to access that and get that money relatively quickly. Answer A. Collin Company's next year's EPS estimate is 2.5 per share. The return on equity is 10%. If the company's dividend payout ratio is 60% and the investor's required return is 9%, then the intrinsic value of Collin Company is closest to. So let's pull in our formula and we'll work through this. Based on the stuff that we're given, we're going to be using the forward PE to figure out the intrinsic value. And what that's going to be equal to is dividend payout ratio divided by R minus G. We're given dividend payout ratio of 60% and we're given R, but we are not given G. So we have an additional step to solve for that growth. But we are given ROE, which we can use. So growth is going to be equal to 1 minus the dividend payout ratio times ROE. And when we work that through, we get growth of 0.04%. And essentially what this is telling us is because we're paying out a lot of this return on equity as a dividend, we only have 4% to invest back into the business. So there's not going to be as much growth as if we were reinvesting all of that back in. So forward PE is going to be 0.6 as our payout ratio divided by 0.09 minus 0.04, which gives us 12. Then we're going to multiply that 12 by our EPS to get our price of 30 per share. Answer A. Which of the following reasons is the least likely a reason why a company's capital structure targets use book value instead of market value? So least likely, meaning two of these will be reasons why we might use book value instead of market value, and one will not be, and that's what we're looking for. So A, market values change dramatically. We can rule that out since that is a reason. Market value is going to fluctuate a lot more significantly than book value, which is just going to be assets on a balance sheet, so those shouldn't be fluctuating significantly. B, lenders and rating agencies use book values in their calculations. We can also rule that out because that's true. That's a key input for them. And C, the amounts and types of capital invested by the company is not of significance. That's going to be our answer because it certainly is of significance. It tells us what the company has on its balance sheet, and that's important for the value of the company. Answer C. Here's a comparative analysis of three companies' price to earnings ratios. So we've got company A, B, and C and their PEs. Which of these companies is most likely undervalued considering they are all operating in the same sector? Is it A, B, or C? So in isolation, looking at these three, PE ratio is basically telling us how much are we paying for each dollar of earnings. So the lower the PE ratio means that it's more likely to be undervalued. And so A is significantly less than companies B and C. So we will go with company A. The method of grouping companies based on industry or product is just one approach among several, and its utility may diminish when applied in contexts beyond industry analysis. Which of the following is least likely an approach used in contexts such as index construction and investment performance evaluation? So least likely, cross it out. Least likely, meaning two of these we are going to use as an approach to what's mentioned in the question, and one will not. So A, geography, we can rule that out since this is likely to be used. It's going to be important in our context because two companies, even though they're in the same industry, if they're operating in different companies or different parts of the world, they're going to have different drivers of their returns based on the economies that they operate in and currency and whatnot. So I think we can rule that out. B, statistical differences. I'm leaning towards this as our answer now. I would say statistical similarities is something we would look for. Once they're grouped by industry, we would want to see what statistical similarities they have as far as how they move relative to certain factors and other statistical measures that we can measure. And C, sensitivity to the business cycle. This would also be a good way to group companies and understand how they will perform or be correlated to companies in different industries and sectors and whatnot. So we're going to stick with answer B. David Smith owns 100 shares of Sprint Craft Incorporated, and the firm is going to elect 10 board directors. Under statutory voting, Smith can most likely cast A, 1,000 votes for only one member in any desired proportion. This is not going to be correct. This is going to be cumulative voting, not statutory voting. B, a maximum of 100 votes for each member of the board. This is going to be our correct answer. This describes statutory voting. You basically get one vote per member per share that you have. C, 100 votes and can spread them across candidates in any proportion. This is not going to be what statutory voting describes. We're going to get more than just 100 votes total to spread across. We'll get 100 per board member. Answer B. Jessica Yang opens a margin account with an initial deposit of $5,000 to buy 500 shares of a bank stock at $22 per share on margin. Her broker stated that her account requires a maintenance margin of 30%. Ignoring commissions and interests, calculate the margin call price. So I'm going to pull in the maintenance margin formula. There is also the maintenance call or the margin call formula, and you can see that explanation on the AnalystPrep website. If that's easier for you to remember, then go ahead and do that. I like to just use this one formula, so I only have one formula to remember, and it's pretty straightforward since you'll be able to just solve for the value that you're looking for, which is the margin call price. So our initial equity is going to be our initial equity per share. I'm going to calculate down here. So 500 divided by 5,000 divided by 500 times 22, since this is what we bought on margin. And then our equity per share ends up at 0.4545 times 22, which is $9.99. So basically 10. And then we're just going to plug in. So maintenance margin 0.3, $10 equity, $22 share price, and then we're solving for X. As we go through that algebra and solve for X, we get minus 12 divided by minus 0.7, which gives us 17.1429. That's going to be answer C. Leopold Bank is currently trading at $53 after declaring a dividend of 3.1 per share for the next year with an expected growth of 5%. If the investor's required rate of return is 11%, Leopold Bank most likely is overvalued, fairly priced, or undervalued. So we're going to use our dividend discount model. We're going to compare that to this $53. One thing I'll note right off the bat, you're given the dividend for next year, so you're not going to have to apply this growth rate to the dividend. So let's pull in that formula. We have our value equal to D1, which we are given at 3.1, If we were given current year dividend, then we would have to adjust that for the growth. And then we simply divide that by 0.11 minus 0.05, which gives us a little under $52. So since our market price is greater than our intrinsic value, we think that the stock is overvalued. Answer A. Company ABC has total assets of $6.2 million with liabilities of $2.2 million. If its shares are trading for $17.78 and there are 450,000 outstanding shares in the markets, then ABC's book value is closest to $4 million, $8 million, or $5 million. This one is straightforward. Book value is simply just going to be assets minus liabilities. So we take 6.2 minus 2.2 gives us 4 million, which will be answer A. B is if you did market cap accidentally. So if you took the share price and the shares outstanding that were thrown in there to throw you off, then you would have gotten 8 million, but that is not correct in this context. Answer A.